Right now, somewhere in Shanghai, a warehouse manager is staring at shelves that used to hold enough silver to make millions of coins. But today, most of it is gone. Reports indicate only around 715 tons remain, down from a pre-pandemic peak of over 5,000 tons. The decline is staggering, roughly 86%, and it's creating a ripple across the global market. Why should you care? Because over the past few months, industrial buyers have been scrambling, offering premiums just to secure delivery. Some of these buyers are paying more per ounce than silver has been trading for decades. The stakes are real. If this shortage continues, the silver you hold, or might consider holding, could become dramatically more expensive, and unlike paper promises, physical silver doesn't appear out of thin air. October 2025 alone saw China reportedly export 660 tons of silver. That's enough to mint hundreds of millions of coins, or fill multiple Olympic swimming pools. And where is it going? London. Analysts suggest London's vaults are running perilously low, and the global market teeters on the edge of what could be a historic breakdown. To understand why this matters, it helps to look at history. Patterns in silver markets have repeated themselves over the past century. In 1933, 1971, and 2008, significant events triggered massive surges in silver prices. And each time, silver didn't just go up, it exploded. Let's rewind to April 5th, 1933. Franklin Roosevelt signed Executive Order 6102, mandating that every American hand in their gold to the government at a fixed price. Compliance wasn't optional. But the gold move wasn't the end. The Silver Purchase Act of 1934 followed, with the Treasury buying silver at artificially high prices. Why? To control the money supply. What happened next? Silver shot from 28 cents per ounce to roughly 81 cents in just 24 months, tripling in 2 years, driven by scarcity, not utility. Fast forward to August 15th, 1971. President Nixon declared that the United States would no longer convert dollars into gold, effectively ending the Bretton Woods system. Gold exploded from $35 to $850 over the next 9 years. Silver followed, going from $1.29 in 1965 to about $48 in 1980, 37 times its earlier value. Some blame the Hunt brothers for manipulating the spike, but the trend was already underway. They didn't create it, they rode the wave. Then 2008 arrived. Lehman Brothers collapsed, sending the global financial system into crisis. Governments responded with unprecedented money printing, and investors noticed. Physical silver and gold became refuge assets. By April 2011, silver had quintupled, jumping from under $9 to nearly $50 in just 3 years. 3 cycles, 3 crises, 3 explosions. But notice something critical. The time between spikes is shrinking. 1933 to 1935 took 2 years. 1971 to 1980, 9 years. 2008 to 2011, 3 years. The cycles appear to be accelerating. And the current cycle? It reportedly started around 2020 with COVID-driven money printing. 5 years in, and we might already be entering stage 3, the point where scarcity becomes visible and panic starts to ripple through the market. Think of it like musical chairs. Stage 1, everyone dances, music plays, everything seems normal. Stage 2, someone quietly starts removing chairs. No one notices because the music is still playing. Stage 3, the music stops. Panic. People realize there aren't enough chairs. Stage 4, the scramble begins. That's where some analysts believe we are now. The music has stopped, and there aren't enough chairs for everyone. Now let's examine the numbers driving this tension today. Industrial demand for silver has been surging at unprecedented rates. Solar panels, for example, require roughly 1 million ounces of silver per gigawatt of installed capacity. In 2024, China reportedly installed over 250 gigawatts of solar, potentially 250 million ounces of silver just for one sector. Add electric vehicles, which use 1 to 2 ounces per car, and AI-driven data centers, 5G infrastructure, and new technologies that barely existed a decade ago. Each new industry consumes silver at scale, yet total global mining production is only about 813 million ounces per year. Industrial demand is over 1 billion ounces. That's a deficit of roughly 95 million ounces for the year. This marks the 5th consecutive year of shortfalls. Cumulatively, since 2021, the deficit may total around 820 million ounces. Despite this, prices have remained suppressed. Why? The paper market. For every physical ounce of silver, there are reportedly between 100 and 400 paper claims. Banks hold massive short positions, selling contracts promising silver they may not have. This reportedly keeps prices artificially low. But something has shifted. China, which had been quietly accumulating silver, flipped its strategy, moving from net importer to massive exporter almost overnight. 660 tons shipped in a single month, the highest recorded in history. These shipments aren't happening because of excess supply. They're happening because London is running out of silver. Market analysts believe China's shipments are a direct response to London running dry. The physical market is reportedly in crisis. One of the clearest signals? Lease rates. When lease rates spike, it means owners of physical silver are reluctant to lend it out, fearing they might not get it back. In London, lease rates reportedly jumped from under 1% to 39% annualized, the highest on record. Then there's the extraordinary step of air freighting silver. Normally, silver moves by ship because it's heavy and expensive to transport. But air freighting, that indicates urgency. Buyers cannot wait weeks, they need delivery now. The US government has taken notice as well. In late 2025, silver was officially designated a critical mineral. This is not symbolic. Section 232 tariff investigations followed, with potential import duties estimated between 15% and 50%. Considering that the U.S. imports around 64% of its silver, this is a significant disruption. Around 75 million ounces have reportedly already flowed into U.S. vaults since October. Industrial users, investors, and institutions are scrambling because tariffs could make imported silver substantially more expensive overnight. Meanwhile, back in China, vaults are depleting rapidly. The Shanghai Futures Exchange reportedly holds just 715 tons, down 86% from pandemic-era peaks. The Shanghai Gold Exchange reportedly has only about 531,000 kilograms, the lowest since 2015. And here's a critical indicator. The Chinese spot price now trades at a premium, roughly $60.30 in Shanghai versus $57.08 in New York. When physical silver commands a premium over paper contracts, it signals a critical divergence. Paper promises are worth less than the real metal in hand. Market observers suggest this could mean there simply isn't enough silver to satisfy current demand. Analysts believe we're already in stage 3 of the market cycle. The music has stopped, and the scramble for chairs has begun. Some claim that China could release hidden reserves to stabilize the market. But consider this. If they truly had massive reserves, why would they deplete public stockpiles by 86%? Why would they export 660 tons in 1 month instead of waiting for potentially higher prices? The behavior doesn't match the narrative of a strategic reserve being saved. Either the reserves aren't there or they are being held for reasons that override simple profit motives. Either way, the physical shortage appears real. And this is where it gets particularly tense. On the COMEX, there are reportedly over 800 million ounces of silver tied up in paper contracts. Physical inventory available for delivery? Only about 40 million ounces. That's a leverage ratio of roughly 20 to 1. If even 10% of contract holders demand physical delivery, the system could face severe challenges. Settling in cash might become inevitable, and trust in the paper market could evaporate almost overnight. Industrial users cannot pause. Solar manufacturers need silver now, today, not next quarter. Production lines risk shutting down if silver isn't delivered, and they'll likely pay significant premiums to secure supply. Governments may intervene once prices spike to $75 or $100 per ounce, launching investigations, imposing restrictions, or signaling caution to the market. But each of these actions could paradoxically worsen the shortage because it alerts everyone paying attention to act quickly. Based on historical patterns and current market conditions, some analysts are forecasting rapid price increases. The base case scenario sees silver reaching $90 to $100 per ounce by mid-2026, representing approximately a 64% gain from current levels. This assumes continued physical shortages, potential U.S. tariffs around 25%, and accelerated industrial panic buying. Analysts like Larry Lippard reportedly target $75 by mid-year, $80 to $90 by year-end. Felipe Geisels at BNP Paribas told CNBC he sees silver surpassing $100 by the end of 2026, and that's the base case. Some believe the market could be more extreme. If delivery defaults occur, export bans are imposed, or investors flood into physical silver simultaneously, projections suggest a $120 to $170 spike by summer 2026, potential gains of 150% to 200%. Does this sound extreme? Perhaps, but history tells us otherwise. Between 1979 and 1980, silver jumped from $6 to $48 in just 14 months, a 700% gain. From 2010 to 2011, silver rose from $17 to $49 in only 10 months, an increase of 188%. Adjust the 1980 peak of $48 for inflation, and it's equivalent to around $178 today. Current prices, around $58, suggest we haven't even reached inflation-adjusted historical highs. The key lesson is positioning. You don't need to predict perfectly, you need to understand risk and act accordingly. If China's vaults are indeed depleted and the market is entering stage 4, consider focusing on physical silver, coins, bars, or allocated storage. Avoid paper ETFs that may not have adequate backing. If you suspect the shortage is real but not extreme, a moderate position across multiple precious metals might be safer. Signals matter. Watch COMEX inventories, lease rates, government actions, and Chinese export data. They provide real-time evidence of a market moving towards scarcity. Being alert is more important than betting on guesses. Now, let's be honest about risks. China could release off-exchange reserves unknown to the public. Industrial demand could falter if prices spike too high. Economic downturns could create temporary deflationary pressures. Governments may intervene longer than anticipated. But even in such scenarios, physical shortages have a way of asserting themselves. If the metal isn't there to deliver, the paper market eventually breaks. And if governments print more money during crises, hard assets like silver tend to rally. As of early December 2025, silver recently hit a new all-time high above $59 per ounce and is consolidating around $58. But these numbers aren't the full story. China's vaults are depleting, London lease rates are at record highs, the US government has declared silver critical, and global deficits continue for the 5th consecutive year. Air freighting indicates urgency. Paper leverage remains dangerously high. All these signs are warning signals. Market participants could be entering stage 4, the scramble. People are realizing there may not be enough silver, and the last buyers may pay whatever it takes to secure a seat at the table. So, where does this leave us? To answer that, we need to step back and look at the broader historical context. The current silver cycle appears to mirror aspects of 3 major events: 1933's government intervention, 1971's monetary system shift, and 2008's financial panic. But this time, elements of all 3 may be converging simultaneously. That's why some analysts suggest this could be the largest cycle in modern history. 1933 taught us that government intervention can drive prices sharply higher, even when the world doesn't yet see scarcity. 1971 showed the consequences of a systemic monetary shift, with gold and silver surging in tandem. 2008 illustrated the effects of global panic and rapid money printing. Today, we see traces of each: depleted Chinese vaults, a potential US tariff shock, and industrial demand growing faster than supply can match. And yet, many investors remain on the sidelines, unaware of how severe stage 3 is, or how imminent stage 4 could be. The musical chairs analogy still applies. The music has stopped, and the scramble for silver is intensifying. Those who act early may secure the best positions. Those who hesitate could pay exponentially more later. So, what should you do if you want to navigate this storm? First, focus on physical silver. Coins, bars, and allocated storage ensure you hold tangible metal. Paper ETFs may appear convenient, but if the system breaks or leverage unwinds, these claims may not reflect actual availability. Second, consider diversification. Precious metals beyond silver, gold, platinum, even palladium, offer a hedge against sector-specific volatility. Third, watch the signals. COMEX inventories, lease rates, Chinese exports, and government announcements are your real-time indicators. These metrics will reveal when the market is moving into critical scarcity. If you're uncertain about the severity of the shortage, a moderate position is prudent. Allocate part of your portfolio to physical silver while keeping exposure to other assets. Set price alerts at key levels: $65, $75, $90. Reassess as new data comes in. This isn't about guessing the top or bottom. It's about positioning in response to observable market stress. Let's be honest about risks. China could release hidden reserves. Industrial demand could weaken if prices rise too fast. An economic slowdown could temporarily reduce upward pressure. Governments could extend interventions beyond expectations. These are real risks. But history shows that when physical shortages meet financial panic, hard assets often win. Physical scarcity doesn't care about paper prices. If there isn't metal to deliver, paper contracts fail, and those holding tangible silver benefit. The current price, around $58 to $59 per ounce, belies the real tension in the market. The numbers alone don't convey the story. China's vaults are nearly empty. London lease rates are reportedly the highest ever recorded. U.S. government actions suggest strategic concern. Air freight is being used to meet demand, signaling urgency. Paper leverage is roughly 20 to 1, and global industrial deficits have persisted for 5 consecutive years. These aren't random facts. They are the warning signs that appear just before stage 4, the stage where scarcity becomes undeniable and prices move in ways most people won't believe until it's already too late. People realize there may not be enough silver to satisfy demand, and the last players standing could pay enormous premiums to secure supply. Ask yourself, are you positioned? If history repeats, those who prepared will benefit. Those who waited may be left scrambling. And remember, this cycle could be larger than anything in recent memory. Elements of 3 previous crises are converging, accelerating the timeline and amplifying the stakes. To visualize, imagine 3 separate storms merging into a single superstorm. That's what's happening with silver. Industrial demand, depleted vaults, geopolitical tension, paper leverage, all converging. The potential for extreme price movement is very real. So here's the takeaway. 1. Act on tangible positions. Physical silver stored securely is your hedge against scarcity. 2. Diversify smartly. Don't put all your eggs in one basket. Spread exposure across precious metals. 3. Monitor the key signals. Lease rates, vault levels, exports, and government actions tell the story in real time. If you're skeptical, that's okay. Watch the evidence. Let it guide your decisions, not speculation. The market doesn't wait for belief, it reacts to reality. And right now, reality is sending unmistakable signals. Finally, consider the stakes. When the music stops, the last person standing may pay double, triple, or even 10 times what silver is worth today. The scramble isn't hypothetical, it's already beginning. Those who understand the signals and position themselves accordingly could be in a position to protect and potentially grow their wealth. Those who ignore the warning signs risk missing the opportunity entirely. So, as of early December 2025, take stock of the numbers, the signals, and the history. China's vaults are reportedly depleted. London lease rates are at record highs. The US has classified silver as a critical mineral. Global deficits have persisted for 5 consecutive years. Air freight is being used to meet urgent demand. Paper leverage remains dangerously high on COMEX. All these signs point towards stage 4. The scramble is coming, and the next move in silver prices could be swift and dramatic. Are you prepared to act? Now is the time to observe, understand, and position. The evidence is clear. Physical scarcity doesn't lie. And as history has repeatedly shown, the consequences of ignoring these cycles can be extreme. The question isn't whether silver will move. It's whether you will be ready when it does.